Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZHONGSHENG HLDG interim report. ZHONGSHENG Group Holdings Limited provides a wide range of businesses and services, including sale and service of motor vehicles for luxury brands, Mercedes-Benz, Lexus, BMW, Audi, Jaguar Land Rover, Porsche, Volvo, AITO, sale and service of mid to high-end automobile brands, Toyota, Nissan, Honda, spare parts, automobile accessories, repair and maintenance services, detailing services, automobile insurance sales and services, other automobile-related products and services. The recent fluctuations in ZHONGSHENG HLDG's stock price can be attributed to several factors. Despite the initial premise that its stock price made no significant changes, data reveals a 40.3% increase over the last year as of March 2021 and a 70% higher share price as of September 16, 2025. The company's volatility was noted at 3.33%. Several news events have contributed to the stock's positive movement. These include lower earnings in the first half of 2025 due to decreased motor vehicle sales, but an upgrade by UBS from sell to buy with a raised price target. Fitch also affirmed ZHONGSHENG Group Holdings at BBB in September 2024, citing its leading market share and strong profitability. The automotive market's steady growth in China, driven by favorable policies and trade-in initiatives, has also positively impacted the company's stock price. Additionally, increased interest from U.S. investors in the Chinese market may have influenced sentiment around companies like ZHONGSHENG Group. The primary drivers of revenue growth or decline in the auto retail industry can be summarized as follows. Revenue growth is primarily driven by market consolidation, government policies, and strategic business decisions. Key factors include consolidation among auto dealerships creating attractive local market entry opportunities, government clampdown on high-interest rate financing products, alleviating downward pressure on auto retail prices, addition of new premium brands and facilities, increased after-sales revenue from premium brand stores due to sole dealership status, auto insurance renewals, and new car sales volume growth. On the other hand, revenue decline is primarily driven by market trends and consumer behavior. Key factors include closure of mass brand stores that used to contribute disproportionately more in terms of after-sales, visits pre-owned automobile business decline due to limited retail value of aged trade-in vehicles, and prolonged price competition, average transaction price of passenger vehicles, downward trend driven by excessive competition among auto OEMs, and sapped consumer confidence. The net income of the company experienced a significant decline, decreasing by RMB 716.9 million or 14.6%. This drop in net income was even more pronounced when comparing the two specific years, with a decrease of RMB 568.2 million from RMB 1,579.6 million to RMB 1,011.4 million. Furthermore, the company's profit margins also saw a decline. The overall profit margin decreased from 6% to 5.4%, while the operating profit margin dropped from 3.3% to 2.5%. These changes in net income and profit margins suggest that the company faced significant challenges in terms of revenue generation and cost management, leading to a decrease in profitability. The company is indeed generating positive operating cash flow, as evident from two key indicators. Firstly, on page 26, it is reported that net cash generated from operating activities reached RMB 5,948,368 in 2025. Secondly, on page 49, the company utilized HK $4,246.18 million to repurchase existing convertible bonds, a clear indication of its ability to generate sufficient positive operating cash flow to fund such significant transactions. The company's debt level and interest expenses have undergone significant changes over the past year. Notably, bank loans and other borrowings decreased by 13%, with a total reduction of RMB 3,437.6 million. The convertible bonds liability portion also dropped from RMB 3,356.2 million to nil. As a result, total bank loans and other borrowings decreased by RMB 3,437.6 million. Consequently, interest expenses have also seen a substantial decline. Interest expense on bank borrowings decreased by 31.7%, while total interest expenses dropped by 13.6%. These reductions indicate that the company has successfully managed its debt levels and interest expenses, resulting in significant cost savings. The company's financial performance varied across different segments in the given period. The AITO brand, new automobile business with Toyota and Mercedes-Benz, pre-owned automobile segment, and after-sales services performed well, with notable growth rates of 9.6%, 7.7%, 4.4%, and 8.1% respectively. On the other hand, several segments underperformed. The new automobile business overall saw a decline of 1.7%, while the new car distribution business experienced a significant drop in cumulative average transaction price per vehicle by 12.5%. The pre-owned automobile segment revenue plummeted by 27%, and sales decreased by 60.2% and 58.4% respectively. Additionally, accessories and others saw declines of 19.7% and 28.8%, while new automobile sales dropped by 0.44 million units and 20%. Management is optimistic about the company's outlook, citing positive impacts from market development in 2025. They are prioritizing business density, customer engagement, and facility efficiency optimization to achieve a 14.6% market share of premium segment customers across core cities. The focus will be on new car sales, with an emphasis on building a premium auto services brand through after-sales services. Management expects revenue growth in the premium segment due to market consolidation and aims to leverage scale advantages for continued business growth with minimal investments and expenses. There were no notable acquisitions or divestitures in this period. The company's financial strategy focused on organic growth and internal development rather than external transactions. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In the past 2 years, it paid out RMB 15,992 in dividends at June 30, 2024, and RMB 2875 at June 30, 2025. Additionally, the company has repurchased shares worth RMB 33,121 at June 30, 2024, and redeemed convertible bonds totaling RMB 20,884 at June 30, 2025, as well as a significant amount of RMB 4,242,695 in 2025. Concerns about inventory buildup and supply chain disruption are mounting in the automotive industry. A widening gap between inventory costs and retail transaction prices suggests that dealerships may be holding onto vehicles for too long, resulting in significant losses. Furthermore, the decline in average transaction price per vehicle by 12.5% in the first half of 2025 compared to 2023 highlights a potential market shift. The high percentage of pre-owned automobiles being sold at 6 years or older also indicates a buildup of inventory. Additionally, an increase in inventory turnover days from 36.2 to 38.3 suggests that dealerships are taking longer to sell their stock, exacerbating the issue. These indicators point to potential supply chain disruptions and inventory buildup concerns. That concludes the financial summary for ZHONGSHENG HLDG. Feel free to comment below, and I will be happy to answer them when possible.